welcome to Global Mantra Market Outlook 2015, a special series that we bring to you each year from the City of London, speaking to a lot of prominent money managers as well as market speakers about their outlook into the new year. My guest today on the show is Giles Keating, who is Head of Research, Wealth Management at Credit Suisse. Giles, it's great to have you on the show. Thanks very much for taking out the time to speak with us. How are you looking at 2015 from a growth perspective? Because global growth hasn't recovered this year. The expectation was that it would in the second half, but it hasn't come by. What will change the picture? What will bring about a recovery in 2015?
Well, it's clear that the US goes into 2015 with a lot of momentum. So I think there we can feel reasonably confident. Europe is perhaps the more interesting case. Europe completely lost momentum in the middle months of this year. And I think we know why that was. It was because the central bank was actually tightening policy, not very visibly, but it was. They were letting interest rates and the exchange rate rise up until about April, May. They then did a U-turn. They've been easing policy, and I think that will give a lot of momentum for Europe into 2015. It won't be the same pace as America, but I think it'll be okay.
What about emerging markets?
Well, emerging markets are really a very, very mixed case. Clearly, those that are dependent on oil and commodity and some of the commodity exporters are really in for quite a difficult time, especially with interest rates likely to be rising in the US, which will impact on them. However, some of the oil importing nations are likely to really benefit a lot. I mean, clearly India is one of those, but some of the others as well. As I look around the world, Turkey, although it's got some issues of its own, will benefit from those lower commodity prices. And somewhere like Taiwan will benefit from much stronger technology demand in the US.
But for somebody who's looking at managing wealth, and that's been increasing, the last reported numbers have shown that global wealth has gone up 8%. Do you think that equities would be the place where incremental money would find its way, just as it did in 2014?
I think on a risk-reward basis, equities really remain the asset class of choice. Valuations, of course, have risen, but in historical terms, they're still not looking overstretched. The equities should benefit from that, beginnings of a new recovery in Europe and the ongoing growth in the US. But there's some people worry that rising interest rates in the US will be bad for equities. But historically, interestingly, that hasn't been the case.
So where would incremental money go within equities? Which regions would draw more capital?
Well, this year, investors have been deeply disappointed with Europe. They were, at the beginning of the year, they thought Europe was where it was at. That's just not been the case. Interestingly enough, as is so often in financial markets, that could turn around completely in 2015. But people are not convinced of it yet. And so there could be a few surprises as people, as it were, go in quite gloomy about Europe and then have to start putting money in when they realise that that's turning around.
Right, but within emerging markets, which are the sweet spots for 2015?
It's really difficult in emerging markets. Why? Because the countries that are looking rather good in terms of growth and reform, like Mexico, for example, already on extremely high valuations, whereas the ones that don't look so good have lower valuations, but they don't look attractive.
Okay, one of the key factors that I've been speaking to my guests about is, the rise of the dollar. And how that could pose a threat for emerging market currencies. What are the views that you're gathering at this point on what that would mean for fund flows? Because a rising dollar would mean more money getting into the US, but it would also perhaps mean that there would be significant depreciation in EM currencies, which would be a great way to play exports within these markets.
Well, clearly that stronger dollar, lower emerging currencies it does help a bit. But of course, the trouble is almost all emerging markets are seeing softer currencies. So is Europe, so is Japan. And so really, we're only talking about an adjustment against the US, which is important, but it's only, as it were, a part of the story. I think the other point I'd make is that with rising US interest rates propelling that dollar strength, that's okay for those countries that have got solid finances, but for those that don't have, there could be quite a lot of difficult pressure.
Right. The other aspect is, of course, rates going up in the US. When do you see that happening?
I think the likelihood is still that will begin in the middle of the year and will carry on quite gradually from there. There are so many push-pullbacks on this. But I think at the end of the day, the Fed will roughly stick to that timetable. Of course, it could be pushed one way or the other if the data is exceptionally strong or weak. But I think it will take quite a lot to push the Fed away from that timetable.
Would you say that this is a secular bull run that we're seeing in the US, or it's still a cyclical one? Or would you say that, perhaps the market has recovered from the crisis lows and we're somewhere in the middle of a rally that actually started in 2012?
Well, I mean, if we take an even longer view, you could say that the current bull market began in 2009.
Actually, yes.
The absolute bottom there.
Absolute bottom.
So, I mean, I think you could say we're sort of 5 and a bit years into that. But normally those long bull runs do go on for quite a lot longer than that.
Is the US in one such long-term bull run?
I think that's probably the best sort of assessment that we can make. We can never be sure. But valuations, if you look at them, say if you just look at 12-month forward price earnings ratios, they're roughly in line with the 25-year average. If you look at any kind of measure versus bonds, then equities still look extremely cheap. And if you look at, we have long-term trend lines that go back to the middle of the 19th century. And if we compare with that trend line, again, equities look somewhere around fair value. And I think, you have to trade above fair value as much as you trade below fair value.
Do you think that this market is different from the market that witnessed the end of QE1 and QE2?
Oh, look, we're clearly at a much more mature stage of the economic cycle. I think when QE1, QE2 ended, the economic cycle was still very fragile. When QE1 ended, the banks were still very fragile. When QE2 ended, we had all of the problems that were still going on in Europe. Now I think the US economy does look much more solid. If I was really worried about Europe, I might say something different. But I'm not really worried about Europe. I think now they've got a monetary policy that's going in the right direction, and they're working their way through their problems. I don't think that will be any kind of real drag on the US.
But is there a scenario that you're building in, and what would be the probability of that, where the Fed is accommodative for the rest of 2015 and only looks at rate hikes in 2016?
Look, I think the Fed would be foolish to delay that long. The longer they do it, the greater the risk that they really start to inflate asset markets. We had a nasty little bout of that in the high yield market in the middle of this year, where spreads were clearly too low, issuance was at crazily high levels. We're now getting back to something closer to normality in high yield, which is not to say there aren't problems ahead. But I think if the Fed were to delay, they would really risk creating new asset bubbles in other places.
And you don't think that the rate hikes would be taken by the markets adversely? There would be a strong reaction, a sell-off in the markets. You think it would be a calibrated move which the markets would absorb because they would be prepared for it?
When rates go up, they do so for a reason, which is because the economy is stronger.
Sure.
So if you're an equity investor, you're pulled in two directions. On the one hand, the higher rates are bad, but the improving economy is good.
Yes.
And history tells us that it's the improving economy that wins out when the Fed starts to raise rates. Of course, on any individual day or week, if we get a more hostile, a more hawkish speech from someone at the Fed, then the market can and will sell off. So there'll certainly be corrections, but the bigger picture is an uptrend.
Okay, great. So that's settled on the US. What about Europe? What about the low inflation prints there? How much of that worries you for 2015?
Europe, remember, is many different countries, and clearly Germany is operating pretty much close to full capacity. It's a country where really I would say we're not really looking at deflation risk. Conversely, in some of the southern countries, for example, particularly Italy, you kind of have to have deflation in order to get the so-called internal devaluation to improve competitiveness. And I think people misunderstand this when they talk about deflation risk in Europe. Of course, you don't want to get into a deep deflationary spiral, but you've got to get some elements of deflation because you are in a single currency zone that is not at all uniform competitiveness. So it's a very difficult balance, but I think there is a route through it.
But do you think that inflation could dip into negative for Europe, for some of the regions into 2015?
I think it's perfectly possible, especially on a headline basis, given the lower oil prices. But the lower oil prices are a positive factor for the economy. I think people can be a little bit, how can I say, simplistic when they look at headline inflation rates and say, oh my goodness, we're getting a negative inflation rate. that has to be bad, not if it's because of the stimulatory effect of lower oil prices.
I think that's also because of what's happened in Japan, right, and the impact that has on asset prices, markets at large, that investors are a bit skeptical about, whether a deflationary scenario can hit Europe as bad, and then the ramifications could be felt in the rest of the world.
I think one should not lift up. You're quite right, people do that, but I don't think they're right to do it, because that's lifting a model from one country and putting it in another where it's quite inappropriate. Japan had 15 years, give or take, or longer, of deflation because it started from property prices that were far too high, from a banking system that was broken. That problem doesn't exist in Italy. It used to exist in Spain, but they've brought down the property prices there. The banks in Italy and Spain either have been or are in process of being recapitalized. It's a very different situation from Japan.
So Europe is a buy for you?
I would say Europe is still a buy at this stage, yes.
Okay. Since you spoke about oil prices, do you think that 2015 is also going to be a depressed year for prices, which would support inflation for a lot of oil importing nations like India and Turkey?
I think it's highly likely to be another year of weak oil prices.
So would that bring about a more bullish stance, like I said, for countries like India and Turkey? Do you think that there would be a more favored view for these regions within emerging markets?
I think for India it's unequivocally a positive, along of course with softness in some other commodity prices. This I think really does help India. And of course comes at a time when there are various reforms going on, which, again, it all points the right way. The only problem is that, of course, valuations are already reflecting a lot of this good news. I think if we look at some of the other oil importing countries like Turkey, it helps them. But Turkey, I think, also has a number of other headwinds and issues that are going on, which perhaps makes for a more mixed outlook there than we would say for India.
I think I read a quote of yours which stated that one must look as a contrarian bet at Russian stocks. Is that fair? Is that...
Well, Russian stocks are just extremely cheap. Of course, as we all know, there are many, many uncertainties there. But I think anyone who is running certainly an emerging market fund has to be aware Russia is still a significant weight in the index. And so to simply say, well, the dangers are too great, we can't hold any Russian exposure, that's a very extreme position with valuations at these kind of levels.
Right, but with increasing wealth, and I'm sure that increases your assets under management as well, where are you going to push for investing incrementally within emerging markets? You spoke about buying Russia. China has done well this year. India's had a fantastic year. Some of the other Southeast Asian markets have performed too. Where is it that you're going to say, all the money that's coming in should get deployed?
I mean, to be in a way brutal about it, I think for investors who've got the flexibility across asset classes, what we're saying is you should actually be underweight emerging market equities now as a broad asset class, because although there is still growth there, of course, the valuations in the countries that have got the really good story are looking very high. And
you think India is expensive?
Put it this way, I think the good news is in there. That's not the same as saying it's expensive, but it's saying there's a lot of good news in there. I think investors will now be looking for both delivery, more momentum in terms of delivery on the reform program. They will be looking for the economic growth to really come through at very high levels, which is perfectly possible. But I think we're now in the stage where investors will want to see, as it were, ongoing evidence. They've already, in a sense, paid up for some of that in advance. Over a 12, 18-month plus view, I think the market can go higher, but only once you've got a lot of that evidence coming through.
So can we see another 15-20% rally for the Nifty? Because domestically, a lot of investors are betting that the flow of money will take the markets way higher and way ahead of fundamentals, because there's so much support coming in on the macro side.
I think one needs to be cautious about this. To talk about big double-digit rises, I think is really pushing it. Certainly, we are saying, look, let's also look much more broadly across the Indian market. There are stocks that have been left behind. I think one really just needs to be careful about this flow of money story. That rarely works in any market.
But when you're saying that there is still opportunity selectively in the market, where would you spot that opportunity? Because everything and anything has gone up. Yes, there's some public sector banks where there's asset quality concerns, so you find some value bargains there. But private banks, whether it's oil and energy stocks, even for that matter, some of the consumer names, export-oriented themes, they've all gone up. So where is it that you're spotting value in India?
No, look, I think what I'm simply saying is that if I look at relative value, then I think some of the stocks in the Nifty have perhaps got a bit more beyond themselves than some of the stocks elsewhere. So it's, if you like, it's less a matter of saying that there are still cheap assets out there. Sure. It's saying that some are more richly valued than others.
So, but from a value risk perspective, what is it that you'd still buy in India?
No, look, I mean, I would be looking...
Or be invested in.
Sure. No, I would be looking to a broad exposure. I think we need to look across the consumer sector. I think we need to look at some of the new opportunities in manufacturing. I know it's very difficult, but... and I think we need to say, look, with the whole energy price environment coming down, I think some of the more energy-intensive companies still perhaps have potential to benefit there.
What about the Indian sovereign bond? What about EM bonds? Do you think there is an attractive case to buy them? In India, of course, the yield on the 10-year sovereign has come off substantially.
No, I think we have to be very careful here. I mean, I think if I look at hard currency bonds across the emerging world, then there are a number of opportunities. When I say opportunities, I mean relative to a very low yield environment. If we look at local currency bonds, whether it's in India or elsewhere, then it can be very difficult. I think in India, we all remember 2 years ago when we had the taper tantrum and the central bank was about to cut rates and then all of a sudden had to reverse that completely, and we had a very, very sharp sell-off in the local gilt market. And I think we should just be aware as we go into 2015, the conditions are not so different. If we all believe that India may well surprise to the upside in its internal growth, plus you've got the Fed moving to tightening externally, this, to my mind, is not really an environment where one should really be banking on the ability of the central bank to make substantial further rate reductions. Yeah, exactly my point, because, what would that do for the currency, given the rate differential? Very, very much so. And, I mean, look, I think let's be clear about it. I think the Indian rupee, it's now in a fairly good position in terms of a country with good economic growth, good potential there for really genuine structural reform, but it cannot be immune to the external environment, and we will be in a much more difficult monetary environment by the end of 2015. The Fed, in my view, will have started to raise rates. The ECB, I think, will have got, as it were, Europe back on a more even keel. Even the Bank of Japan may not be, as it were, we may not have quite such prospects for major new stimulus there. So the global monetary environment, I think, will be a lot less friendly. And I think it's very important that the Reserve Bank takes account of that as it goes through 2015. But do you think the currency would largely be ranged between 61, 62? It's been a very tight range for the rupee this year. Well, look, we can never be sure about narrow ranges, and there can always be moments. Again, I give the example of last year where we did see a lot more volatility for a short period, exactly around the time when people began to discount in the Fed tapering. I wouldn't, as it were, say we're definitely going to have an incident like that in 2015, but it wouldn't surprise me if much of the year was the narrow range, but with just moments of tension. How do you think money would get allocated between India and China and some of the other Asian markets? Indonesia also has been a market which is showing a lot of promise, whether it's in terms of growth, whether it's in terms of exports. How do you think investors are feeling about the Asia Pac within emerging markets? And is it largely an overweight stance? I think it's a very, very different stance as they look at those countries. I think India, as you say, it's been in a sense, the easy bet for people this year. As we go into next year, the underlying story is still there, but the valuations are now so much higher that inevitably, I think, that will dampen down the flow of money into India. Investors then have to be saying, where will we put that money instead? I think they will continue to put some into China because I think they will become more and more confident the risk of a growth collapse is lower than they had feared. As for Indonesia, I mean, of course, we still wait to see how the new administration will perform. Indonesia always tends to be that much more volatile. And again, that will, I think, dampen some of the flows. But I think when you do get periods of weakness there, you will fairly quickly see the flows coming back in.
What I'm gathering from your comments, it seems like there would be a case where investors would look at booking profits from the stupendous rally that India has seen this year and perhaps reallocate within the region. Is that fair?
I think there will be a balance. I think there will certainly be investors who've ridden that rally in India who will indeed want to book profits. I think there will be other investors who've perhaps missed the story who will then fairly quickly come in to fill that gap. And that's just a way of saying that, as in any market after a big bull run, you're likely to have some setbacks and then resume the story based on strong underlying fundamentals.
How do you feel about the coming year? What's your broad sense of how the year would pan out, and how do you compare your thoughts to what you had at the start of 2014?
Well, I think I feel fairly positive about 2015. I do believe that we'll get really quite good growth in the US, and we'll see Europe on a slower rate, but perhaps beating some of the pessimists who are worried that it can all fold down. Japan remains an enormous unknown, and we're going to see some quite big changes coming through there, perhaps after this new election. And as for emerging markets, I think there are real bright spots, of which India is clearly one. And if I compare that to last year, or I should say this year, well, yes, I think we had some of that optimism at the beginning of this year, and Europe was the big disappointment, and that really dragged quite a lot of things down with it. I personally don't think that will be repeated in 2015, because I think the monetary policy is so much more accommodative now.
So what would be your top 3 investment ideas then for the year?
Well, it would be focusing on some of the European growth stories, including some of the exporters and the banking sector, which I think has got real opportunity to turn around. It would be focusing on US large caps, which I really think are set to benefit from the ongoing global growth. And then for fixed income, it's so much more difficult, but I think we would actually there be focused on some of the emerging market hard currency debt.
All right, Giles, we'll leave it at that. Thanks very much for taking out the time and speaking with us, sharing your views into 2015. Well, with that, we come to the end of this edition of Global Mantra Market Outlook 2015.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.